Hey everyone, welcome back to the pod. Today we're diving into a whirlwind of market moves and tech triumphs, unpacking the latest from Wall Street to Silicon Valley with a mix of surprises and expected twists. Let's start with the broader markets, where yesterday's Federal Reserve decision set the tone. As anticipated, the Fed cut interest rates by a quarter point, signaling their ongoing effort to balance inflation and growth. But Fed Chair Jerome Powell threw a curveball, cautioning that a December rate cut isn't a done deal. That comment sent ripples through the markets, with the S&P and Dow taking a hit, while Treasury yields and the dollar surged. It's a reminder of how much power the Fed's words wield. Investors hang on every syllable, trying to predict the next move. Why does this matter? Well, uncertainty around rate cuts can spook markets, as businesses and consumers alike rely on predictable borrowing costs to plan ahead. This hesitation from Powell could mean tighter financial conditions for a bit longer, and we'll be watching how that plays out. Shifting gears to the tech-heavy NASDAQ, it's a different story. The index soared to yet another record, largely thanks to Nvidia, which we'll get to in a moment. But first, let's talk earnings, because big tech delivered some blockbuster numbers, and a few stumbles. Google's parent company, Alphabet, smashed expectations, crossing $100 billion in quarterly revenue for the first time. That's a staggering milestone. Fueled by a 34% surge in Google Cloud, investors loved it, sending Alphabet's stock up 7% after hours. What's driving this? It's the relentless demand for cloud services as businesses everywhere pivot to digital infrastructure, and Google is reaping the rewards. Meanwhile, Meta also beat revenue forecasts with a 26% year-over-year jump to $51 billion, powered by platforms like Instagram Reels, where user engagement is skyrocketing. But here's the rub. Meta's stock tanked over 8% after hours. Why? A one-time tax charge played a role. But the bigger concern is their aggressive spending. Meta's ramping up capital expenditures and operating costs faster than revenue growth, especially as they double down on AI and future tech like augmented reality. Investors are nervous about profitability taking a backseat to ambition, even if that ambition could position Meta as an AI leader. It's a classic tension. Short-term pain for long-term gain, and the market's not quite sold yet. Elsewhere in tech, Microsoft faced its own challenges. Despite earnings that mostly beat expectations, its stock dropped as much as 4% after hours, compounding losses from an earlier Azure cloud outage. These disruptions aren't just technical hiccups, they erode trust in a platform critical to countless businesses. It's a stark contrast to the Nvidia juggernaut, which just became the world's first $5 trillion company. Think about that, $5 trillion, representing 16% of U.S. GDP, bigger than the main stock indices of Germany, France, and Italy combined. Shares jumped over 4% yesterday after a slew of announcements, including $500 billion in AI chip orders through 2026, partnerships with Nokia and Uber, and plans for new supercomputers for the U.S. government. Nvidia CEO Jensen Huang is riding a wave of optimism, dismissing bubble fears by arguing AI represents a fundamental shift in computing. But here's the cautionary note. While Nvidia's valuation at 30 times forward earnings isn't as wild as some peers, that $500 billion in projected revenue isn't guaranteed. Major clients like OpenAI and Oracle face financial question marks, and some of Nvidia's own investments and partners raise concerns about artificial demand. It's a high-stakes bet. If AI delivers as promised, Nvidia's worth every penny. If not, that $5 trillion could start looking shaky. So, what's the big picture here? We're at a fascinating crossroads. The Fed's cautious stance signals economic uncertainty, while tech giants are betting billions on a future dominated by AI and cloud computing. Some, like Nvidia and Google, are seeing immediate rewards. Others, like Meta and Microsoft, are navigating investor skepticism. For us as observers and investors, it's about balancing the hype with the hard realities. These companies are shaping tomorrow, but tomorrow isn't promised. Stay tuned as we keep tracking these stories, because every day brings a new twist. Thanks for listening, and I'll catch you on the next one.